Hey everybody, welcome back to the channel. I've got Jack with nobody special with me, and we're here to warn you of the recession that is on the way. We've got some new metrics that when you put all these metrics together, they make up the LEI, and leading economic index. This is interesting because these are the real numbers. I heard these acronyms on George Gammon. I went down the rabbit hole for myself. I immediately called Jack and said, Jack, we've got to tell everybody because this is very important. Thank you for being here. Hit the like button, subscribe, and ring the bell because it's only good if you like it. And it ain't worth a dang if you don't. It goes for everything, right? So, Jack, thank you for being here, buddy.
Anytime, Chris. Thanks for having me on.
Absolutely. Now, this LEI is made up of average weekly hours in manufacturing. Okay. Average weekly initial claims on unemployment. Manufacturing new orders from consumer goods and materials. Real data, real stuff that really matters to the real economy, but is completely divorced from reality like everything else. What do you think about the LEI, Jack? And then we're going to throw this chart up in just a second.
When you first called me last night, we caught it was we haven't talked in a while. It's good to hear from you. You asked me about the LEI. I'm thinking, what is that? A ticker? Is that a stock? I'm not terribly familiar with the index. And then when I went and looked into it, you showed me the link. I said, wow, this is actually pretty good. It's a very forward-looking index. It takes snapshots in time of certain economic data points, like you mentioned, like new orders at factories and weekly hours or worked, and it uses that to make an informed guess on what is coming in the future. And what we're seeing in the LEI is really pretty powerful stuff here. There's one category that's doing very well, and virtually every other category is not doing very well or doing very poorly. And this chart says a lot. There's a lot of fancy language in here. There's a lot of different terms that people might be familiar with, but this very well explains what I think the disconnect between the average person, what he's feeling, and what the people in the financial press are telling us about how everything is just so good. The economy is good. Everybody's better off. Why can't, what are you, too dumb to realize how good you have it? And this does a pretty good job of showing us that.
So the gray line that doesn't make wild swings to the bottom and the top is the GDP.
Yes. Real
and
GDP.
The gross domestic product.
Yep.
And you'll notice, go back to the very first dip. Everybody, look at the difference between the LEI, the one that's made up of things that aren't so manipulated, and the GDP, the one that just kind of doesn't do so bad. It accurately predicted the dot-com bubble in 2001. It nailed the 2008. Look at where it was in 2007. Right, that's it, right there. And then look where we went. It is accurately predicted every recession in my adult life.
Yeah.
So,
and more importantly, it moves first. It moves first and it moves fast before GDP, real GDP moves. That's another thing. It is a leading economic indicator, as in you see it here first.
how did it predict COVID? How did it do that one in 2020? I mean,
That
it
is
nailed it. Look at the little
interesting.
blip, and we had the check mark. But the most important takeaway from this chart to me is where we are now, because that's what I hope to get people to get a grip on. Take some money off the table. Don't worry about that extra 10% that you might get, 20%, whatever. You can actually turn that money that you have in your stocks, bonds, and mutual funds into something hard. Some people can do that. It's been a very excellent time for people's retirement as the stock market has been going parabolic. And we actually might have a dip if it's anything like the last 4 times or 3 times. Now, going on with the metrics,
Okay.
How is this chart
All right. So
put
what we're
together?
looking at here is all the components that make up the leading economic index. There are some financial components and some non-financial components that go into it. All right. Now this chart's a little confusing. This vertical line here, that represents 0. If it's to the right of the line, it's going up, or, basically it's bullish for the economy. If it's to the left of the line, it's going down, bad news for the economy. All right. Now the gray bar is the 6 months ending in November. And then the blue line is the actual data point from November itself. So you've got one thing you'll notice here. Virtually every category is in negative territory, showing economic contraction. All right. And the most powerful data point here, you do have a couple that are in positive territory down here at the bottom, but you're talking just barely. The only really positive number in this whole 10 component index is the S&P 500 index of stock prices. So stocks are up and almost everything else is down. And man, if that doesn't just summarize the ridiculous state of our economy, I don't know what does, because everybody is feeling the pain of inflation. Everybody's quality of life is falling. Things are getting worse. Talk to any business owner, and yet number go up. Stocks just keep going up. And this is telling us, hey, that's not right. Something is really wrong here. So you've got, go ahead, Chris.
No, you keep going.
So some of the components, you've got the leading credit index. I was looking at the leading credit index. That's its own separate indicator that's made up of 6 of its own components. That has a lot to do with risk in the debt market and interest rates and the spreads between high risk interest rates and low risk interest rates. So I'm not going to get into the weeds about what makes that up. Just know that that is showing contraction, significant contraction in the leading credit index. So there are problems flashing in the debt market, and we see that in other places as well. The S&P 500 obviously is positive. Stocks are near all-time highs right now. Number go up. The next one is one a lot of people are probably familiar with, maybe not phrased this way. They're saying interest rate spread, the 10-year Treasury bond, less Fed funds rate. What this is basically is talking about is the inversion of the yield curve. How inverted is the yield curve? How much lower are long-term interest rates versus short-term interest rates? And right now, short-term interest rates are a lot higher than long-term interest rates. That is the bond market saying there is a recession coming. So that's also a component of this index, the inversion of the yield curve. You also got non-financial components, average consumer expectations for business conditions. That's more of an opinion survey that I believe University of Michigan puts that one together. That just kind of takes the temperature of how people are feeling. That's one of the most negative components of the whole index. You've got ISM, which stands for the Institute of Supply Management, their index of new orders. That is a gauge of large factories across the country. Hey, are you guys seeing orders for new businesses? Do people want stuff? Those have been negative for well over a year now. That's another one that's deeply negative. Building permits for private housing. That's one that's not quite so negative. It's actually doing all right ever since interest rates have started falling at the end of October. That one has been improving, but it is still negative over the prior 6 months. Average weekly hours in manufacturing is another big one, because that's a leading indicator. You see bad things show up there first, because talent is hard to attract and hire and retain and train. And so when things get bad at the factory, they'll typically cut back the hours first before they start laying people off. So if you start to see a drop in average hourly earnings or average weekly hours, that means there is a drop or a spike in unemployment coming on the horizon. So we're starting to see slight reductions in weekly hours also. You've got manufacturers' new orders for non-defense capital goods, excluding aircraft. That one's a mouthful. And that's important because you can't use, say, the war in Ukraine to create the illusion of economic growth by ordering new missiles just to fire them and blow things up. That will be technically a new order that a factory would receive, but this data point takes that out, because that's not real economic activity, right? That's just bad people doing bad things. And they also exclude aircraft, because aircraft is a very volatile component of new orders. If Boeing gets an order for another 2737 MAX jets, which probably isn't happening now, but if that were to happen, you would see a huge spike in manufacturers' new orders. And then the next week, in the next month, you would see a huge drop because there wasn't that order for aircraft. So when you pull out aircraft from the orders, you get a smoother picture of what's going on in the factories. So this long-winded one, manufacturers' new orders, non-defense capital goods excluding aircraft, is really saying, like, besides bombs and airliners, what are people ordering? And that one is also negative, just barely. Now, the last two that are just modestly positive, manufacturers' new orders for consumer goods and materials, those are up ever so slightly. But I would add those are up from some very low levels because for the better part of the last year and a half, this number has been falling. So, yeah, it started to tick up a tiny bit, but it is still a long way from a good-looking trend. And the last one is initial weekly jobless claims and unemployment insurance. That one is still looking okay, up barely. We just haven't seen the spike in unemployment yet. So that is telling us that the big contraction in GDP is still a few months out because people haven't started losing their jobs yet.
Right. And I'm looking forward to our video on the jobs, the fake jobs, the big lie that they've been telling us. So, guys, it's that simple. I just wanted you to look at the chart and try to, because it takes some conviction to take action. Because I know a lot of people were like me, and the question I asked myself daily, used to, was, what am I going to do? How do I get ready for this? Because they put it off. The longer they put it off, the worse it's going to be. It's festering.
Yep.
You know, it's like a bad relationship. It only gets worse. There's never a good time. And when it gets here, and they're not able to just stimulate their way out of it, I think it's going to be pretty gnarly. It's going to be the recession could turn into a short depression, and then, you know, they ease interest rates and give away money, and then it gets better for a little while, and then we enter the Thunderdome, you know.
And, you know, you mentioned the recession may be coming, Chris. I think we may learn in the not too distant future that we're already in the recession, and that
well, what I mean by the recession's coming, I mean the talking heads on TV it'll be a buzzword in the media.
Well, if I might mention the talking heads on TV, Chris, the talking heads on TV, they live right here in this data point, this one positive data point, the S&P 500 stock prices, right? That's where they live. So they're going to tell you soft landing, mission accomplished, all that stuff. And the talking heads on financial TV, they get paid by the guys in this category here that's doing really well, right? All the financial advisors that advertise on their channel and BlackRock and Vanguard and all the index. So of course, they're going to tell you everything is really good because they benefit from you thinking that. But I mean, look at every other component of this index, which has been incredibly accurate in the past in predicting recessions, which I'll show you in the next chart. Everything else is either just kind of meh or really bad. So, yeah, of course, the guys who live on this bar, this one little island of positivity, are going to tell you things are great. What's the matter with you? Can't you tell how good things are? But the guys who run the factories, you know, the guys who build the houses, they're all saying, no, something bad is coming. The inversion in the yield curve is saying something bad is coming. I mean, I get it. A lot of people have been saying that for a while now. But these other indicators, the new orders and the hours, they continue to get worse while they tell us everything is better. There's one more metric that I wish was in here, and that's pallet manufacturing. The pallet business, 3 people have reached out to me, and they said it hasn't been this bad since 2008. Or one of them said that. The other one said they're just really slow, and he's had to lay off people for the first time since 2008. So, you know, that would have been a really good metric to add, but you can add it for yourself. Come up with your own canary in the coal mines. That is a pretty good point, Chris. The pallet indicator, if you will. A lot of the logistics, 2023 was a horrible year for the logistics industry, right? Like, it was accentuated by the Yellow trucking collapse. When Yellow filed for bankruptcy, 30,000 jobs were lost when that happened. But virtually anywhere you look in logistics in 2023, it was a terrible year for global trade. And the only reason the shipping carriers aren't still going belly up on a weekly basis is really what's going on in the Red Sea right now. Shipping rates have exploded higher across the world since the thing happened in the Bab el-Mandeb Strait. Now everybody's got sail around Africa. So the shipping carriers are doing better because of the higher rates they're able to charge. But things are still really bad. And, because the new orders are down, the indexes, the ISM index and new orders X aircraft, all those things are down. People don't need pallets because the factory isn't making things and shipping them. So you're right. That would be another really good indicator.
There's a really big pallet business down the road. I noticed they are flush with pallets. There's some people over one town over. I was going over there, and they had pallets stacked. It looked like they were, I don't know, maybe they were hung up with them, or maybe they're just accumulating them, but they're starting to be pallets stacked up everywhere. And that should be, we'll call it the pallet indicator. Maybe it'll be good to go back and see what the pallets did 2006, 7, and 8. Maybe it'd be good, check 2001 too while you're at it.
So that's another, if say you're in the pallet business, right, and this indicator would show something like that, the thing that's probably happened right now is they're cutting back hours at the pallet factory. So that would show up in the average weekly hours here, along with the slowdown in new orders. But maybe they haven't started laying the guys off at the pallet factory yet, and so it hasn't quite hit those initial unemployment claims. So again, this is a leading indicator, and something like you're talking about would show up in this indicator.
Okay. Yeah. All right, guys. I do not want to keep you. I want to give you the meat of the story and check out the LEI for yourself. You can find it on the Conference Board Lending Economic Index. Google the Conference Board HIT Index, and it will take you straight to it. And all you have to do is scroll down and check it out for yourself. Jack, thank you so much for coming on. And guys, check out Nobody Special Finance. He has excellent content. And if it wasn't for the Nazis on the tubes, he would be way up there. But, we've all got a battle to struggle through this. But one day there'll be a different platform, and it's going to be a lot better, I believe.
Thanks a lot, Chris. Appreciate you having me on, and thanks for telling me about this indicator. You brought this up last night, and then I dug into it, and I remember thinking, wow, this is really good. This is a really well thought out indicator. So good stuff here. Thank you, sir.
Yes, sir, Jack. Have an awesome, awesome day, everybody. Later. And end recording.
We're still recording.
Just hit it with your finger.